After years of helping people invest and retire successfully, I've seen countless investing mistakes, such as buying high and selling low, reacting to the news, etc. And I've learned 8 key lessons that I want to share with you all today so that you can avoid these and become better investors. For those of you who don't know me yet, I'm Julia, Certified Financial Planner and Managing Director of URS Advisory. I have spent the last decade of my life not only studying finance, but I manage millions of dollars for our clients who are approaching, newly, and in retirement. Every day I help people retire when they want and how they want. And in order to do so successfully, you need to know which common investment mistakes to avoid so that you don't derail your retirement plans. Before I get started though, please be sure to like and subscribe to our channel. This helps us get this free information out to as many people as possible, and we really appreciate it. Okay, let's jump right in. Mistake number 1, unrealistic expectations. Oftentimes, when people just start investing, their rate of return expectations are all out of whack. According to the CFA Institute, individuals reported a realistic average annual return as 15.6% per year, even though the long-term average for the S&P 500 is 7 to 8%. So why does this matter? Well, disappointment leads to bad decision-making. And if your expectations are unrealistically high and they're not met, this could cause you to make emotional investment decisions that can massively undermine your ability to retire. Remember, investing is a marathon, not a sprint. So it's crucially important to set realistic expectations yourself or work with an advisor that can quantify your risk-return ratio so that you know what to expect in your accounts. Mistake number 2, losing sight of investment goals. It's so easy to be influenced by news or intraday market moves, but it's important to remember that you're planning for your lifetime, decades, not just days. I love this quote by Jules Marceau where he said, "Plan in decades, think in years, work in months, and live in days." To me, this says, keep your plans and investments long-term, think about who you want to be years from now, set actionable work goals over months, and live in the now. But investing just in the right now is unsustainable and unsuccessful the large majority of the time. An example of this would be a recent retiree who bucketed their money between safe and aggressive investments just before a bull market run. And they're feeling frustrated that their total investment return didn't keep pace with the S&P 500. The reason we bucket our money upon retirement is to neutralize the sequence of returns risk, or the risk of pulling income from a losing investment. This causes you to run out of money much sooner. So, if the risk of a market crash on your financial life is greater than the opportunity of being invested in 100% stock, then you must bucket your money for your own financial well-being. Mistake number 3, buying high and selling low. It sounds simple enough. But in reality, when investors become emotionally attached to companies or funds, this can easily happen. You can hold on to a losing stock long enough to finally give up on it just before it turns back up. Or you can be pushed out of the market due to a poor emotional decision, such as an election, etc., only to buy back in after euphoria has taken hold right before a market correction. If we look at this chart, we can see the psychological cycle that takes place to push us to buy high and sell low, and we do not want to be a part of this cycle. This is where it's so important to either have a like-minded peer that you can talk to or an advisor to work with that you trust that can bring you back down to earth when you're feeling fearful or greedy and prevent you from making irrational financial decisions. In our practice, we use sophisticated software to tell us exactly how much our clients stand to gain in a bull market and lose in a bear market. So when they can see their risk quantified in dollar terms, they can then either accept it or slightly adjust it based on their comfort level, as long as they can still meet their financial goals. This way, they have total risk awareness and a better mental preparation for market corrections. Okay, mistake number 4, paying too much in fees. High fees can eat away at investment returns over time. Over the years, I've seen mutual fund fees go all the way up to 2% per year and A-shares with loads of 5 to 6%. In today's day and age, we no longer need to pay up for high-performing investment funds. At URS, we keep our management fees extremely competitive and use very low-cost ETFs to keep our clients' fees as low as possible. Every dollar they save in fees is another dollar in their pockets. Mistake number 5, reacting to the media. This one really pulls on my heartstrings because I've seen too many friends, acquaintances, even family members make terrible investment decisions based on the news or an election, and they've missed out on a ton of investment returns and money because of it. There are plenty of 24-hour news channels that make money by sensationalizing what's really happening and making people fearful or greedy so that they become hooked on watching. The problem with this when it comes to investing is that the news is already priced into the market. So by the time you find out about the news story, it's too late. Remember when the media just knew that we were going into a recession at the beginning of 2023 and that the market was sure to crash because of the March banking crisis? Well, just after that, the market shot up 24% in 9 months. At URS, we use an investing system that tunes out the noise of the media, and it's been very rewarding both financially and mentally. Our job is to keep our clients level-headed through the noise so that they can make the highest possible returns. Mistake number 6, forgetting about inflation. Have you ever heard the phrase cash is king? I have to say I disagree. A cup of coffee in the 1970s cost just 25 cents, and a cup now costs, call it $2 if we're excluding Starbucks on average. That's a 680% total increase and an average increase of almost 14% per year. Inflation is a very real concept, and we've just experienced a large dose from early 2022 to now. So, if you're holding cash or have it in a bank account that's earning next to nothing, you are actually losing money each year. This is called purchasing power risk, and it refers to the possibility that the value of money will decrease over time due to inflation. So, you can purchase less with your dollars over time, and this can seriously hurt you in retirement, especially because you don't have any new savings coming in. Over decades, the two main asset classes that are able to outpace inflation consistently are stocks and real estate. And this is why at URS, we believe that everyone, regardless of age, should hold at least 40 to 50% in stocks at any given time. Mistake number 7, working with the wrong advisor. If you and your advisor are not on the same page, or if you leave their office feeling more confused than when you walked in, you may need to consider switching. Your financial advisor should serve as a helpful liaison between you and the stock market and serve as your partner in achieving your financial goals. They should speak in plain language and address all areas of your financial life: budgeting, insurance, tax planning, Social Security planning, income planning, and of course, investment management. The benefits of taking the extra time to find the right fit far outweigh the comfort of making a quick decision. All right, folks, we're on the last mistake, number 8, and this one is never starting. This one also gets me because as a 36-year-old, I have a lot of friends and peers who still haven't put $1 into the stock market. Sometimes it's due to truly not having the extra income to save, but I find that many times it's a lack of financial education, a fear of the stock market. But there has never been a better and easier time to start than today. We can now trade without paying fees, choose and purchase investments easily, all through the comfort of our cell phone. Check out this graph of the difference between starting to invest at age 25 versus age 35. Both people started saving $5,000 per year up to age 65 with a hypothetical annual return of 7%. That 10-year start time difference equates to over $500,000. So, the best time to invest was 20 years ago, and the second best time to invest is now. If I missed any mistakes or if you have a personal experience with any of these, please let us know below in the comments, and we can all stand to help each other here. And if you need help with any of these mistakes or more, please don't hesitate to reach out to us. See you next time.